Anmol, welcome. We were just chatting about the golf clubs and piano. I actually have one piano and golf clubs in the office as well. Anmol is in the trading space. I think he has like an online community called like livetraders.com. I never really got into day trading, so I'm interested to hear like what you got going on. I've done some like shorting here and there and some like longer term hedging strategies. However, I haven't talked to anyone in the day trading space, and you're in a space where I don't know like what's going on social media, like who's legit and who is just like Davey Day Trader.
Yeah, there's a lot of that in the industry. Just like I guess the whole online space, right? No matter what business you're in, hard to really know who's like really doing it or who's just like in it to make a buck.
Yeah, so like what what got you into day trading? Like did you go to like school for like finance or mathematics? Did you like learn from someone? Like what was your like the genesis of getting introduced to day trading? Most people are like I bought a triple leveraged ETF on margin and then I lost
Yeah.
everything.
Yeah, no, for me, I think it all started in college, in my university dorm room, complete, typical introvert. So I was always on my Xbox. I always wanted to find something that I could do from my computer, something where I don't have to deal with like the office politics or any of that. I went to university for business degree, so not really to do with trading or investing. In fact, I was horrible at, numbers growing up, so I thought this was the last thing I ever thought I'd be doing. But it was a time in college where like, everybody applies. I went to college in London, so in the UK, you before you could graduate, you had to do like 1 years of work experience. And in that time, like I remember applying for like a lot of different jobs, a lot of different opportunities, but I just couldn't get in anywhere. So that was the whole year. It was a wasted year for me. All my friends got internships and jobs, and I didn't have anything to do. So I just, just like anybody else, go online. What can you do? And I think at any point in life, I think for every man, you're curious about the markets. You're like, okay, why does the stocks move up and down? What causes that? And I found myself like really getting like really curious about it. Like I wanted to know, I wanted to learn. And I had nothing better to do the whole year. So I just dived in and started researching, reading on the subject, taking just like everybody else online courses, going to all these things. And then I joined a prop firm. A prop firm is basically a company that gives you their money to trade, and in exchange, they take a percentage of everything that you make for them. So I traded with them, kind of worked my way up the company from 2010 to 2015. Did that for 5 years, and then 2015 is when I started my own livetraders.com.
So how do you get involved with a prop firm? Never heard of that.
Yeah, prop firm, short for proprietary trading firm. So there's a
Hmm.
bunch of them. Back in the day, used to be really popular. Nowadays, it's kind of hit or miss because nowadays they're just like glorified brokers, basically. They don't really care what you make or not. Back in the day, the company would give you like their own money to trade, and you start off. They put you on a demo account, which is everything's real, but the money's not real, right? Prices are real, stock movements are real. They put you on a demo account, and then they give you certain targets. If you meet these targets like 2 weeks in a row, then we're gonna give you a little bit money. Let's say they started me off at $50,000 and then they gave me more targets. You hit this target, then you're going to go up to $75,000. And if you hit these targets, then you go up to 100,000 and you kind of work your way up. And I got up until like level 8 where I was trading like $10 million of their capital. And then they would take a percentage of everything that you made for them, 30%, 20% of whatever you made. So yeah, you got to work your way up in the company like that. Back in the day, they used to be really good because they actually used to coach you. The reason or the way they made money is if they taught you, you did well, then they have hundreds of traders around the firm. Some lost money, some made money, but then, they would make money on the big chunk of them. So you got to kind of work your way up, which was great for me because they also give you loss limits, right? Like if a certain amount of loss in a week, the platform just locks up. You can't even trade, right? If you hit your loss limit, that's it. You come back next week. The platform won't even work anymore, which was great for me because that, developed like good risk management habits, which most traders these days don't have because they're trading their own money. They could lose it all. Nobody's watching over them. Where the company in morning meetings, right, afternoon meetings, like there's a lot of accountability. So I think that's kind of what I attribute a lot of my success to is those early days.
Yeah, like one of the things I like to do is what you're referring to is like paper trading. Like, hey, you can get a paper trading account and play with fake money before you start playing with
Yeah.
real money. However, until you start playing with real money, that's when the whole game changes, regardless of how long you practice on the paper trading.
Yeah.
Um, but one of the things I like to do uh, is just go into our accounts and go into read only mode because it won't let you place any trade. So it's like, hey, like I'm a little unsure what to do. Let me just go in read only mode because then I have to actually like get in, log in, and like go through some extra steps rather than nowadays. It's so easy to buy and sell. From my point of view, I believe it's actually going to be easier to make better long-term decisions because of what platforms like Robinhood are doing and promoting, which I don't believe is probably in most people's best interests.
Yeah. Yeah, I mean, I think it's level the playing field, meaning everybody has access to the same stuff now that professionals used to have access to like 20 years ago. Back in the day, you used to have specialized platforms that you used to get, which most people don't have access to. Then you get the professional data feeds. You have all of this stuff that people had to go through these hurdles, which was good and a bad in the same way. It was good because, well, if people go through these hurdles, then by the time they get there, trading real money, they've proven themselves. Whereas nowadays, people can just open an account, and just buy random stuff, and there's nobody stopping it. You can Apple Pay to your account, Cash App to your account. Like it's all sorts of, which is good and bad. Good because now everybody's access to it, so it's not just limited to like a, closed community in Wall Street or whatever. Everybody can do the same stuff. So that's good. The bad, as you said, is like there's no people don't learn. They just go on Reddit. I just want to buy this random GameStop, or I read this on Twitter. I'm just gonna go buy this, and that's a surefire way to lose your money. But yeah, to your earlier point, yeah, demo account, tell people just spend like a couple weeks in it, just learning the platform, learn it, how to get in, how to get out, get comfortable with it. But then as soon as you figure that out, you should go to real money ASAP because a lot of people that I've trained, like they spend so much time on like say demo account. And as you said, when they go live, now you get those emotions kicking in, right? And people also treat a demo account like they wouldn't do the same stuff with real money. Demo account, let me buy 1,000 shares of this thing. If it was your real money, you probably wouldn't do that. You probably buy like 10 shares, right? So you got to trade like you would if it was your real money. But then as you get comfortable, as soon as you can, move into real money. Now, real money doesn't mean you start risking it all. You start really, really small amounts of money, small share size, and then you give yourself the same targets. If I hit this target, my account grows by this much, then I can buy a little bit more shares, right? So you have to earn the right, we call it, earn the right to raise your risk and not just gamble on it, because otherwise you're going to be a statistic just like everybody else who tries this business. And over the years, coaching people, I've seen it's like a revolving door. People come in, they want to learn, they learn the hard way, they realize, oh shit, this is harder than I thought. They leave, new people come in. It's like a revolving door. And the people who stick around have mastered like personal money management skills, risk management skills, which are more important than picking the right stock.
So with your trading strategy when you were starting out to hit these metrics, what were your metrics and what was like the strategy that you were using? Was it just individual companies, options, a mix of both, shorts, longs? Like walk us through the process on how someone learns about more sophisticated strategies than just following someone on Instagram who tells them just buy the SPY. It'll get you where you want to be regardless of what the price is.
Yeah, so I mean, and when I started off, it was just purely stocks, both long and short, but I didn't really do options when I started. Now I do primarily do options, but when I started, it's just about the stock because I think before you do anything else, like options or anything else, you still got to know where the stock is headed, right? So first you get really good at analyzing the stock, and I do that to chart patterns and technical analysis. Once you figure that out, options just a derivative. It's just a derived from the price of the stock. So if it's just a way to capitalize and make more money on your original position. Whereas in a stock, to buy 100 shares of Tesla, it's going to cost you $100 multiplied by 223, right? Whereas if you buy an option, you could buy that for like 10,000 bucks. So it's leverage position, right? Which means like you need to know what you're doing because otherwise that 10,000 could immediately go to zero. Whereas a stock, it's not really going to go to zero, right? I mean, Tesla's not going to go to zero. Microsoft's not going to go to zero. With the option, it could go to zero. So you really need to know what you're doing. So I always tell people start with chart reading first, get good at technical analysis, get good at stock picking, and just do stocks for a while, right? Once you're good at it, then option is just a way to make more on that original trade that you would with a stock position. But yeah, long, short, both, because they're all the same. Patterns are the patterns, right? Whether long or short. And I think as a trader, you got to do both because otherwise, like for example, last week, this week, markets have been, coming down. So if you're trying to go long, you're probably not going to make any money, right? Whereas if you're going short that day, you have more likelihood of doing that. So a good trader would do both long and short, completely unbiased. I don't really care about the company. I don't care about the CEO. I don't care about anything. It's just stock is a stock for me. So that emotional detachment to the company is key. I could be long something today. I could be short it tomorrow. And I think that's the key to trading is being nimble and not like having a bias, like I love this company. I mean, then you're emotional. Then you're gambling basically.
Mhm. So when you were starting out, you're just doing long and short positions when you're first starting out? What was your minimum metric for you to go from level one to level two? What was like the
Yeah,
sort of
so
results you needed to see?
yeah, so level one, they gave you $50,000, right? Once you cross through the demo levels, you got 50,000, and your goal was like literally just make $200 a week, but make it 2 weeks in a row. So one week you made 200, next week you made 190, you
On
still have.
$50,000, just
Yeah,
$200?
that's it. Because we had loss limits too. They wouldn't let you lose more than like $200, right? If you lost $200 for the day, your platform is locked up, come back next day. So they would try to build you up like that. So the level one is just $50,000 cash to take the positions, but you're only allowed to lose, let's say, a couple $100. But in your profit target would be like a couple $100 2 weeks in a row. Now level two, same amount of money, 50,000, but now your goal increases to make $500 2 weeks in a row. So one week you make 500, next week you make 400, you're not promoted. You got to hit 500 2 weeks in a row. The level three, they got you like $75,000. Now your targets increased to 750 a week, 2 weeks in a row to get promoted. So sometimes you would hit it like first week you hit 750, next week maybe you're down $100, no promotion, continue on. So you kept like that, and then level three, level four, now you get 100,000. Now you go $1,000 a week, 2 weeks in a row. So all the way up until like level 10, which was like level 10 was like 10 million or $15 million, but now you try to make like 10,000 a week, 2 weeks in a row. So the capital is not that important because capital is just the capital, right? What's really important is the loss limits, what you're going to lose, what you're going to make on that trade. So that's what they would do, and they would have like hundreds of traders in a desk. So if everybody's trying to make them 10,000 a week, 2 weeks in a row, I mean, the company makes a lot of money that way, and they used to take a percentage of everything you'd make.
Got it. Were you doing this like full time? Because in the beginning, I mean, it sounds like you can't make like a ton of money on that sort of system. Like, were you like working another job while you're doing this? Like, you do this in the morning, then like have something else? Like, what were you doing before you scaled up to like what you're doing now with what is it, livetrader.com?
Yeah, I mean, I didn't make any money my first year. I lost money my whole first year because it was like a lot of mistakes, right? You learn the hard way, you have bad habits built up, or you're trying to get rich fast, you're trying to hit your targets. First year was all like a disaster for me, but then I realized like psychology is like a lot more important than that because anybody can learn how to trade. I can teach you, hey, look at this technical pattern, and you could learn it in like a day. But can you do it though consistently? Can you get out when you're supposed to get out? Can you accept a small loss? I think those were the key learning lessons for me. But I think the benefit, as I said, for myself was I started trading in my dorm room in college. There's not a lot of expenses, right? College is paid for, dorm room you're paying for. So I had like a good, I would say, leg up than anybody else who's starting maybe in their late 30s, 40s. Because now, well, either you gotta have savings, because you're probably not gonna make money in the first few months, just being honest. Most people don't, right? Typically takes people 1 or 2 years to get to a point where they're consistently profitable. So either you have your savings built up that you have a runway to learn, or you have another source of income coming up, right? Like a lot of my students, they would be doing it. Let's say if they're in California, they trade from morning from 6 o'clock till like 8 or 9 o'clock. Then they'd have an actual job that they go to while they're learning how to do this. For me, the benefit was I was a college student, so I didn't really have to worry about making money that year. But yeah, year two, year three is when I started making money and progressing through the levels in the company.
Gotcha. Yeah, I mean, one of the things with like day trading is you're getting in and getting out, so you're realizing all short-term gains and hopefully minimal short-term losses. How does that work out from a tax perspective?
Yeah, so I mean, the tax perspective, you're gonna pay the capital gains tax, right? If you're doing short-term trading. But the key is like you're hopefully, if you're a good trader, you're making a lot more than the tax is just like a cost of doing business, just like you would in any other business. But if you're just doing short-term trading, that's a very hard way to make a living. So I always tell people like have three different buckets. So we have one style is called the income producing style, which is day trading, which is like a job. I come in every day, I trade 2 to 3 trades a day, and that's what I use to pay my bills, to live off, and to have an income. Then the other style is the wealth building bucket. In that bucket, we're doing trades for more longer term, meaning I might buy a stock today, sell it next month, buy it today, sell it next week. And then there's the core trading bucket, which is like long-term investing, stuff that I'm not even touching. So percentage, 10% of whatever I make from my day trading automatically gets invested. And that's for the long haul that I'm not touching. Right. And then there's going to be trades that I might take, buy something today, sell it next month. Those are more longer term trades. But yeah, you're going to pay, regular capital gains taxes on your short-term trades. And then anything over the year, your investments, those you can, let it ride just like anything else. But yeah, I let my accountant kind of handle all of that, So yeah.
So when you have like all the short-term gains, but all of your income is derived from day trading, you still have to make like a good amount of money to hit the different taxable taxable levels because the
Yeah,
short term is based off your marginal tax rate. So in the beginning, if you're not making a ton, you're probably not paying a ton in taxes if that's your
right.
sole income.
Yeah.
Now, like some people are like, hey, you can open up like a LLC and stuff. Do people actually do that? Is it legit or is that just like
No,
wishful
it is
thinking?
legit. A lot of people do it under LLC, so that way you can write off a lot of different stuff. Like if your home office, right, a percentage of that you could be written off. But it's not a big meaningful thing, like whether you do it on personal or not. LLCs only really matter once you cross like a big threshold. Maybe now you have a team, right? Maybe you have some employees, maybe you have something else going on, right? Or your basic stuff like internet and stuff. But again, in a long enough thing, it's a very minuscule amount of write-off, so it's not a huge difference whether you do it in LLC or not. You're still going to pay taxes anyway on your trading. So whether you do it LLC or personal, you still got to pay taxes.
Yeah, gotcha. I mean, it's just one of the things like people are like, oh, like if I open up this LLC, I won't pay any taxes.
Yeah, it's all the social media stuff, right? They just hype up everything on social media is like, do this, and you could do this. I mean, I try not to mess with that taxes portion. That's one thing I've realized. Money comes into my account, I automatically take, 40%. It's tucked away in a different account, so I don't have to worry about it. Because, you could take all these write-offs and stuff, but people don't factor in audits, right? So I try not to take like, I even home office stuff. I don't write any of that off because it's like I don't want to get into any level of audit, right? Because that's something you don't want to get into. So I just listen to what my accountant says. He's like, all right, this is what you owe. I take care of it, and I don't try to like shortchange it. I'd rather just make more and pay the taxes, but then, focus on like how I can save a few buck here and there and get myself in a situation that I don't want to get myself into.
Yeah, it's all about avoiding, not evading. That's
Exactly. Yeah.
that's the
You can't
secret.
avoid it. You can avoid it for a certain amount of time. People can get away with it, but if you start making any level of decent money, then you just don't want to deal with any of that headache. So it's like automatic for me. Money comes in, I take 40%, put it in a different account, so I never have to worry about it.
Yeah, and with like technical analysis and charting, it's helpful. However, what I've felt is anyone can like say they know like, oh, this is a head and shoulders or reverse head and shoulders. Like those things are easy to read. Where I've really found a difference is being able to look at the chart and then coincide that with like, is the company profitable? What's the short float against the company? What's the volume? What's the price to earnings ratio? Is that something that you also look at? Because the charting and technical analysis is like the beginning stages, but really understanding the profitability and versus speculative amount of a company is definitely the difference because if you're trading purely on momentum and the company doesn't make any money on that next earnings call, uh, things could go down quickly for you.
Yeah, I mean, I personally don't really look at fundamentals because one of my rules in trading is we never hold stocks through earnings unless it's a long-term investment, right? If it's an investment like Tesla that I, let's say, plan on holding for years, great. You can, that you have to hold through earnings because it's an investment. But as a trade, one of our biggest rule in at least in our companies, we never hold a stock through earnings. Because, how many times have you noticed a company reports great earnings, stock still goes down, or a company reports horrible earnings, stock still goes up. So it's basically a gamble holding to earnings. It's like a roulette table, 50-50 odds. If it's 50-50 odds, I don't want it, right? So we never hold it to earnings. Every position that I have as which is meant to be a trade is exited way well before earnings because I don't want to deal with that, wake up and oh, is it up? Is it down? I don't want to deal with that. So I'd like to come in fresh. So I'm only trading the patterns prior to the earnings report or after the earnings report. And I skip that part about earnings report unless, as I mentioned, if it's a long-term investment of your stock that you believe in. But the reason I don't really look at fundamentals is because, again, markets are primarily driven through emotions and fear and greed and momentum. So you, like me, have seen tons of stocks that have crappy fundamentals, right? Like, but the stock's still going up, right? And
Mhm.
stocks that are great companies, stocks still going down. So it's like the fundamental for me is like a added benefit that you could use to maybe give yourself more confidence in taking the trade. But if you stay in the basic rules, like ignore speculative stuff, ignore like, I don't really trade crypto stocks. I don't really trade like biotech stuff, anything that could get me in trouble. Because then those things are driven by, FDA reports or anything like that. They could come in and completely destroy the technicals, right? So that I try to stick with like the major stocks that are like proven and they're going to be around for a long time. So on those technicals work like a charm. And I think technicals are really important because, you and I and hundreds of people, we could all be in the same exact stock at the same exact time, but our returns are going to be vastly different based on what? Based on where we bought them, right? So knowing where to buy is absolutely crucial. So I think that's one of the things that people miss. Everybody wanted to buy Tesla when it's at $400, right? But now when it's going down, nobody wants to buy it. But it's the opposite oftentimes that we have to do in terms of technicals is like we call it in our firm, we call it feed the ducks. When the ducks are quacking, you feed the ducks. When everybody wants to buy the stock, that's usually the time when we're looking to take profits. When nobody wants to buy it, we still don't buy it. We wait for it to come down to a technical level, and then we look to buy that stock. And Tesla was a great example of that just this year as well as a couple of years ago.
You mean when it went from like 400 to 100?
That was amazing. Yeah, because I never owned Tesla, right? Until it dropped down to that 120 level, right? I think it went down $100 or something, picked it up at 120, right? Because again, technically it was coming right into a major trendline support, bought it there. Stock went back to like 300, 470. I think I tweeted out that day, sold it at 450, some at 460, 470. And now I'm starting to buy it back again, just recently, yesterday and today.
Yeah. So one of your rules is you don't hold companies through earnings. So meaning if you looked at a company and saw they've missed earnings 10 times in a row, you still don't even look at that.
No,
That's like
yeah.
one of the I like to call like 10 commandments. I have like my 10 commandments of investing
Right.
that like I follow. Occasionally though, I do break the rules because sometimes you do have to break rules when you like have a conviction.
Yeah, a conviction is definitely true, but I always tell people conviction is earned right? If you've been doing this for a while, you've been involved in the markets for a while, then you've built experience. So then the conviction, your gut feel is basically your experience talking. Hey, you've seen this before. This is how it usually plays out. You should try it, right? But if somebody's brand new, you don't have gut feel because gut
Mm.
feel comes from experience. So most people when say, I feel the stock is going to go up, I'm like, based on what? Like you don't have any track record. So I think that's the key with trading and investing is like building that over time. And over times, yeah, sometimes you got to bend the rules a little bit in your trading, but as long as the core commandments are there, like meaning risk management. So if I'm getting into a position, first thing before I even take the trade is I decide when am I going to get out if I'm wrong. Most people never think about that, right? Every single trade I take has a defined exit point. If it breaks this level, I am out. I'll take a small loss. I'll walk away, move on to the next trade, right? So the ability to take small losses is key to trading. I think everybody talks about winning trades, but what's really important is learning how to lose the right way because that protects your risk level. So an example of like a random trade we would take is let's say I buy Tesla at $200 a share. And I say, okay, if it goes below 180, I am out. I don't want to hold it. So then I know I'm risking what, $20 a share. So then I
Hmm.
know, okay, if I only want to lose, let's say $1,000, I know exactly how many shares to buy, just dividing that by $20. So then it gives me the exact share size I should buy. So then if I buy those amount of shares, so example, buy something at $10 a share, it goes down to $9 a share. That's my exit point. I'm risking $1 per share. So if I want to only lose $10,000, I'll only buy 10,000 shares. So if it goes down, I know exactly what I'm going to lose. So there's no uncertainty. And on the upside, same thing. You got to have your targets in mind. When are you going to get out if you're right? Most people never do that even correctly. They think, oh, if the stock goes to from $10 to $20, I'll sell it. Now it's at 20. I think it's going to go to 25. I'm going to hold it. They're gambling basically. They don't have a plan. So I think that's the important part about trading successfully is to have an exit points if you're wrong, exit points if you're right. Those are the key before I take the trade, not after.
The worst is when you get out and then you find out later you were right.
Yeah, and that happens,
It
right? Like,
happens.
yeah, we cannot control it. It happens to me all the time. I mean, it happened to me today, right? So it's like that's part of the game, and you got to realize that anybody who says they know for certainty this is what the stock's going to do is completely lying. Nobody knows what the stock is going to do. All you're trying to do as a trader is get the odds in your favor, just like a casino would, right? Like you could go to a casino and win $1 million. They're not going to mind. They're going to give you the money. In fact, they're going to say, here's some free drinks, here's a comp. Just keep playing because they know that this is their edge that they have. The longer you play in a long enough time frame, this point percentage edge they have, they're going to come out ahead. So same thing with trading. We're trying to just build the edge in our favor. So it's not about this specific trade that I want to make money on. It's all about a sample size. If I take 100 trades, I want to come out ahead based on the statistic. And we do that by tracking. We go back like hundreds of years and see what this pattern would have produced. And so I know that this is the percentage edge that I have. And all I got to do is just big enough sample size, let that edge play out.
Yeah, one of the items actually have on my desk, I like printed it out and like taped it on. It says, markets can stay irrational longer than you can stay solvent. Protect your downside, but if your conviction holds, let the market prove you right. Just don't get emotionally attached to being right focused on being profitable.
That's 100% true. Was it somebody in Market Wizards, I think, who said that?
Maybe I think it might be Ackman or someone.
Yeah, so
Bill
it's
Ackman.
true. 100% true. Because that's why I tell people don't have ego when it comes to the market. Nobody knows what the stock is going to do. All we're trying to do is trade our conviction, our edges, and patterns. And the half the battle in trading is actually waiting. Like some days I'll come in and I'm like, I don't like anything today. And that's a day where I'm okay with not taking a single day trade. I'm okay with that because it's not about today. It's about weeks, months, quarters, years. So I think half the time is waiting. I think another quote from the Market Wizards book, I think forgot who it was, but he said like, half the battle of a trader is just waiting for the trade to set up and waiting for the money to be there, and all you got to do is just pick it up, right? Rather than forcing it. A lot of traders that I've seen, even in our chat room in our community, like they want activity, right? What am I going to trade today? I'm like, today, nothing. It's horrible odds today. We're just going to sit and do nothing. And I think people are not comfortable with that. They're always looking for that opportunity. And I think that's the wrong way to think.
You got to be like Garfield. You remember Garfield?
I actually don't know. I don't. I mean, I know Garfield.
Garfield the
Yeah,
cat.
yeah, yeah. Yeah.
He's like, I think he says like, I don't know the exact quote. He's like, well, if I just sit here long enough, something will happen.
Yeah. Half the battle is just waiting for the pattern to show up. Sometimes there's no pattern, right? You just gotta wait. And I think that's the key to trading. You don't have to always be in a trade. Sometimes it's best to be nothing, but waiting for the right opportunities to present itself, something that you've tested over time. Like okay, this pattern has a X percentage win rate. This is the win-loss ratio of that strategy. So now if you know it's profitable, then you just keep executing on it. But if it's not showing up, you just gotta be okay with sitting on your hands.
Most people can't do that.
That's the tough part. That's why most people don't make it in this business, right? Because they're seeking for that thrill, that adrenaline rush,
Hmm.
or maybe they saw something on Reddit. Oh, look at how much this guy made money. Nobody shares their losses, right? That's the thing with online. Everybody talks about all their winning trades, all the good stuff they did. Who knows what they're really doing in the background? Who knows how much money they've lost in the background? And I think that's the key. People, you should not compare yourself with anybody else's success because, well, you might be trading with 10,000, he might be trading with $1 million. So it's all about percentages, not the amount that somebody's making or losing.
Yeah, I mean, it's hard to know what's real. Is there anything that when you're watching someone, you can like identify pretty quickly whether or not they're legit or not?
I mean, the key is like, can they do it live? Like, if they're just selling like a course or like join my newsletter or Discord or whatever, or I'm just going to text you stuff, but you can't actually watch them do it, then it's hard to trust it, right? So, the reason like my company is called Live Traders is I live stream every single day and have since like 2015. So, it's all live stream. You can see my account, you can see my face, you can see my camera, you can see my screens, and everything I'm doing it in real time. And that's number one key. The other key is track record, because I don't care about how much money somebody makes or lose on that one trade or that one week. Want to see the track record. So every single trade that I've personally done or called is tracked in a spreadsheet for everybody to see over the last like since 2015, right? And every day is live stream too, so people can watch me do it. I think that's the key. But I think the biggest thing is it's a red flag if somebody only talks about winning trades, right?
Hmm.
It's all like winners. Look at how much money we've made. Look at how, like, really, no trader win every single time. I mean, I lose a lot, right? Today I had a losing trade too, but it's all about like the longer term picture on how you can do it. So red flags typically, I think people who trade like penny stocks, forex currencies, a lot of that market is quite shady. It's filled with like MLM network marketing companies and all of that stuff. So usually forex, big red flag, or people sharing like P&Ls, P&L screenshots. That's a huge red flag for me too, because a real trader doesn't really care about you looking at me and saying, "Oh, look at me." I don't care, right? So, and I think there's a couple of red flags, but I think the more you do it, you realize it. But I always tell people, try it, try everybody, right? Try it, try following them. If you can't follow it, it's probably not real, right? Or if it's a penny stock, or if it's like a pump and dump, right? Like a lot of people do this. They buy the stock and then they send it to their community. Hey, I just bought this and everybody buys it. So yeah, naturally it'll go up and they'll look like a hero. But that's not reality trading because maybe if they never sent out the email alert to their people, maybe the stock never would have gone up. Right. So I think the key is that. So when I
Hmm.
take a trade, I always tell them before I take it, hey, if Microsoft gets to X price, then I'll buy it. And when it triggers, this is going to be my stop loss. I'm going to get out if I'm wrong. This is going to be my target. And that's defined before I take that trade. So it's not like I'm getting in and then telling everybody. It's like we're trying to do it together. And I'm also trading pretty major stocks, Apple, Microsoft, Tesla, Q. Like I'm trading the big stocks. I'm not really focused on those lower priced kind of stocks.
Yeah, what was I gonna say? Warren Buffett always says like they only like to swing at pitches they like. Like one of the big headlines now is they're like, "Oh, why do they have so much cash?" It's like, well, they're a $1 trillion company, so them having $300 billion in cash is like someone who has $10,000 has $3,000 in cash. It's really not that crazy. Plus, they have like the insurance company, so they need to make sure that they have enough money to pay if they have any liabilities, as well as a lot of the money is not even theirs because it's through the float. And that's like
Right.
one of the things I've been seeing on social media is like everyone's like, "Oh, a crash is coming, a crash is coming."
Yeah.
Uh, However, most people just don't understand like what's happening. We had like one money manager on here, and he was explaining how these people that have like these like they'll come up with like a recommendation, and they'll
Mhm.
tell half the people to buy and half the people to sell,
Yeah.
and then they tell the other half to do the same thing, buy and sell, and then it's like, oh, this person was right 10 times in a row.
Right.
But it's just math. Like if you tell
Yeah.
50% to do one thing and 50% the other, you'll be 50% correct.
Right. Yeah. As I say, right, the broken clock is right twice in a day. So yeah, I mean, it is true. And I think that's why you should never rely on like you should build your own trading plan. Like never rely on anybody. Even though like I have these newsletters and stuff like that, I always tell people use it as a learning resource to see why I'm buying it, where I'm buying it. Can you spot that pattern, right? Like try to learn and then you eventually get it and do it yourself. Because if you're relying on somebody for advice or career, then you're always reliant on them. Like if you're building a career following all of my trades, awesome, you're making money, great. But what if I choose not to do it tomorrow? What are you gonna do? Stop your business? Right? You're putting all your eggs in one basket. So it's not a great thing to do is rely on people and like Jim Cramer or like people listen to CNBC or watching hedge fund managers, but then don't know 95% of hedge funds underperform the market, meaning you're better off just buying the S&P 500 and getting better returns than putting it in a hedge fund. But those are the people think about, oh, hedge fund managers, he must know something. They don't. Most of them lose money, right? I mean, there's a lot of funds that are always on CNBC, but you look at their track record, it's horrendous. Literally, like you could buy the market and outperform them by 10 times. So the key with hedge fund, because almost was going to open mine like 3, 4 years ago, filed the paperwork with SEC, ready to open my hedge fund. And I went on these networking events with hedge fund managers, right? Donated to their charity so I can have dinner with them, learn the business a little bit. And none of them talked about trading or investing. All they talked about was like how to raise money. Then I realized this is the wrong game I'm in because I like the art of trading and investing, not like going to networking events. Who can I raise money from? Increase my assets under management. And being an introvert, I don't like to do all that stuff anyway. So I think that's kind of why decided I'm just going to do it by myself rather than buy myself a job and now I have to do compliance and SEC, go to these events, kiss a lot of frogs, raise a lot of money. It was just a different business. So you got to realize hedge fund game is more about networking, raising money than it's actually about trading or investing.
Yeah, and I mean hedge funds are great for people who already have a lot of money because they're not concerned with getting like 10% market returns. They just want to
Right.
get reasonable returns with downside risk with a hedge fund manager who's going to be doing, calls and puts and limiting their upside, but also limiting the downside. So that, I mean, they're happy with that. But when you
Yeah.
have $50 million and it's just like cash that you need to put somewhere and you're not going to put it into CDs or a high yield savings account like what people on social media are being taught. You're going to put it into a hedge fund, you're going to pay 2%. If you're making 5 or 6% year over year, you're happy with that. However,
Yeah.
what you're looking to do is probably a lot better than 5 or 6% year over year.
Oh yeah, for sure. If you're going to do 5 or 6%, you might as well just buy the S&P. You're going to get 10% roughly over the last few years average cost. So, but yeah, for 99% of people who don't want to do this for a living, right? Like they have another job, they have another business. I tell them like don't even try to day trade. Enjoy your business, enjoy your job, build income from it, take a percentage, invest it in the S&P 500, right? Market's gonna, your money's gonna double every 7 years historically if you do that on a compounding basis. So just do that. Trading is something like if you really genuinely like it. Because if you don't like it and it's just for the money, like if you don't actually enjoy it, you're not curious about it, then there's no point trying to learn it because you're not going to last, right? If you don't have a passion for it, when things get tough, when you don't make any money your first 6 months, you're going to give up, right? But if somebody's like literally learning it, okay, looking at the statistics, wow, you know what? When I go long between like 10:30 and 11:30, I have my highest success rate versus if I trade later in the day. Like I'm very granular with the things that I track. Win race, loss race, long, shorts, time of the day I take a trade, price of the stock. Like it's very minuscule detail. And a lot of the work is done in spreadsheets for traders. And then when the market opens, is just executing on whatever you've back tested.
What's one of like the spreadsheets that you have
So
that
we
you
have
track?
yeah, we built it on our own, so it's like a custom spreadsheet and we track every little detail on it. Like, the time of the day you took a trade, the size of the stop loss, price of the stock, was it against the market trend or with the market trend? Like there's just and management too. Once you get into the trade, how do you decide when to get out? What's the average move your trades get? Like it's tracked in a certain way that once you use all of these data points, then you create a system that's, long term going to be profitable. But again, most people don't want to put in that kind of work, or they don't even think about tracking that. But I always tell them, if you're going to start a business, wouldn't you track every little thing? Like if you have, let's say, I don't know, if you own a franchise, or if, let's say you own a 7-Eleven, you're going to know, okay, does Monster Beverage sell more? Does Red Bull sell more? And you'll notice that, right? Like in some stores, you'll see Red Bulls right over here. Some you'll see Monster. Different neighborhoods have different needs. So they track every little thing too, where to place which product, right? Oh, you know what? In this location, pizzas don't sell well. This stuff sells better, right? They're going to stock more of that. Same thing with trading, all these little data points to just give ourselves a little bit of an edge, just like a casino has a little bit of an edge.
Yeah, I mean it's good to have that. The way I like to look at things, which is I like to track things, but sometimes like people start tracking things and then they just like get stuck in like tracking. Like
Yeah.
versus it sounds like what you have is like rules and a system. You still need to track things, but if you follow the rules in the system and then
Mhm.
also track, that is also going to like help you protect yourself from yourself, which is the
Yeah.
investor's worst enemy is themselves.
100%. Because we could track all this data, but what good is the data if you don't actually follow it, right? So that's the whole different ball game, is like learning how to execute on the sample size. Not about that one trade, sample size. Like that's how kind of the traders need to think. And just being disciplined, like actually following the plan. If the plan says get out if it hits this level, make sure to get out. But what most people do, I think it'll come back up. Let me buy more. Let me lower my average cost. Now they're just digging themselves in a hole. And I tell get comfortable with paper cuts, right? Paper cut losses, and make sure your winners are at least, twice the size of your average loser. Because if your winner is twice the size of your average loser, let's say each loser is $1,000. As soon as you lose $1,000, you automatically get out, take a loss. So then each loser is going to be $1,000. But if each winner is a $2,000, let's say, now you only need to be right 40% of the time, right? So you could take 100 trades, lose on 60 of them. If you just win 40 of them with the 2-to-1 ratio, you're profitable. But most people wouldn't do that. What happens is their losers are bigger, the winners are smaller. So the ratio is never going to work, no matter how well or a great trader you are.
Yeah, investing in golf is a game of opposites.
Hmm.
The harder you try in golf, the less further the golf ball goes. The
Ah,
harder
yeah,
the harder you try in investing, the harder it is. It's like the
yeah.
more that you're like open-minded, have your system,
Mhm.
do the same routine every single time.
Right.
It gives you a higher chance of getting a little ball in a hole or making a profitable trade.
100%. Maybe you had a bad, first round golf, but okay, there's, other 8, 9 holes I can play. Maybe in the next ones I'll catch up. It's the same thing with trading. This one I didn't do well. Get out of this one, take a loss. Next one I'll make up for it, right? So the same thing. Golf is actually a perfect analogy because golf and trading is very similar, right? It's a meritocracy. There's nobody else controlling your results. It's you. The ball is just sitting there. It's your ability to execute on it. That's it. Nobody's influencing it. Maybe the wind, all of those other factors. Same thing with the market. The market dynamics, the news can always influence your trade, but it's just you and the computer, really. That's what golf really is. The ball is just sitting there. It's not moving. It's your ability to execute on that. So it's a perfect analogy. I mean, that's why I picked it up last year, although not very good at it, still learning, but getting there slowly.
Yeah, well, you start from the Tiger Woods started from the green back. If you can't get the
Yeah,
ball in the hole, it doesn't matter how far you can hit it.
exactly.
So it sounds like that's the same philosophy you took with investing is, all right, do this, then learn
Yeah.
that, and then you start adding to your repertoire over time.
Yeah.
Um, I was gonna ask, a thought came in and then it came out. I was gonna ask, what was the most memorable loss that you took, and what did you learn from the loss?
Memorable loss. I don't know, man. I tried very hard to forget all of them because I try to focus on the winning because I really believe in that. I think whatever you focus on, again, might sound hocus pocus or whatever, but like I really believe in like that, like putting your focus on what you want to attain rather than the losses. So I try not to look at them, although I have plenty of them, right? I think the most recent one that I had was Apple. This was, I think, maybe 3 or 4 months ago. And I was coming from like a big winning streak, right? 95% win rate, which never lasts. Reversion to the mean is a very real thing, happens to everybody. And I got really overconfident. I was like, like last 20 trades have been winning. I'm just like on a hot streak and I took overly bigger position that I should have ignored my risk management rules. I should have exited for like a $5,000 loss and I ended up holding and I did the cardinal sin of trading, which is adding to a losing position. I did that, got stubborn, and yeah, I ended up taking a pretty big hit on that one. It took me a couple months to, recover from that. But yeah, I think part of the game, those happens, still happens to me. Still, like once or twice a year, I'll have that where I'll like just, take over the risk that I should have. But as long as you make that like 1 or 2% of the time you do it, you can recover from it. Problem with most traders is they do it almost every day, every week, and you don't want to try to do that.
Yeah. So when you enter a position, are you only getting in once and out once, or do you sometimes be like, "Hey, I'm gonna put $1 into this. I'm gonna do a quarter at a time, and then like sell a quarter out"? Because sometimes, like, if you just choose one and one on the in and outs, obviously, you're trying to time exactly, but if you average in or average out, sometimes that could be helpful.
Yeah, for day trading, I do one in, one out. I
Okay.
just try to keep it simple. But yeah, when if it's a swing trade or if it's a long-term position that I'm in it for days, weeks, or months, then yeah, I might like slowly piece it out. So like Tesla's a great example, right? $120 drop, picked up a bunch of shares, and I scaled out. Sold some at 300, sold some at 390, sold some at 450, sold some at 470. By 470, I was out. So then I was scaling out of the position, so locking in profits along the way, because who knows where it's going to go to. So yeah, in the long-term stuff, I usually scale out of those positions. Same thing with buying. If it's a long-term position, I'm not going to buy it all at once. I'm going to scale into it. So Tesla recently, when it dropped from 470, I think I bought some at 300, right? Bought some at 250, bought some yesterday at 220, and I'm in like 70% of my position now. And my goal is, if it goes down 200, that's when I'll probably get full on that position. So yeah, scale in, scale out for more long-term stuff. Day trading, I do in and out because it's very quick trades that we do there.
Yeah, you might like this app. I met with someone who like works on this app. It's called like the Dub app. Have you seen it? Where they can copy your trades. So like you can create like your own portfolio
Mm.
and like users can come and like copy your trades and you're able to like people I guess like be a manager without being a manager.
Yeah, no, I did that actually a while ago. Not dub, but when I used to trade currencies and all of that with the prop firms, I had my own model that people would just kind of subscribe to, and it
Hmm.
would copy all the trades for them, and it was great because I was taking pretty much like a fund, right? You're taking a percentage of whatever they made. It was a great business model because I'm doing the same stuff in my own account, and I just get to make more money doing that. It was amazing, but my accountants and my lawyers advised against that. They said it's a gray area. It's a gray area, right? So because then you're kind of going into the investment advice route in a way. So he just said it's not worth it. So I ended up not doing it anymore.
Hmm.
Yeah, it's a gray area. I don't want to anything to do with the gray area that potentially could be something. I just stay away from it because more money often is not always worth it. So you got to look into the regulation. Now, if I was offshore, if I lived in like Dubai or London, like most people, in this space too, yeah, I'd probably do it. But I just don't want to I just listen to the advice of my staff.
Yeah, you gotta have the people who pull you back sometimes, even though you may not like it.
I know, and it was a good hit. I was making a good amount of money doing that, right? For the couple of years, but then if he just said it's not worth it because one little thing, and let's say because if I'm okay, let's say if I lose, I'm okay with that. But what about other people? You don't know what if they're sophisticated or not. They might be a crazy person, and then they're like, "Oh, I took this trade, and it did this, or it lost money, or whatever." I just don't want to deal with any of that stuff because people, if they know what to do, I tell them just do it yourself now. So like I'll tell you what I'm buying and selling, but you're on your own. I'm only showing you what I'm doing. I'm not giving you any advice.
Yeah. Well, Anmol, it was fun, man. Check out livetrader.com. We'll see everyone next time. Bye, everyone.